Everyone knows you as the bond king. Can you just tell us a little bit about bonds? Give us a very short overview on why bonds are so important within a portfolio or within the markets. What do they tell us?
Well, I think the great place to start, Noah, is why should you even look at bonds? Because nobody cares about them for the most part. I mean, there's more bonds being traded than equities, but you don't go to a party and be like, hey man, did you get one of those new 30-year treasury issuance? Like, no, nobody talks about that, right? It's the IPO, the crypto, the hot stock. That's what we want to hear about. But from a macro perspective, why should people even look at the bond market? I mean, maybe they don't want to trade it. Maybe they don't want to invest in it. That's fine. But what should you know about it? And the real key to the bond market is it tells you if financial conditions are easing or tightening. And we brought the arrows along for the day's show, so I like to use these in my YouTube show. And when financial conditions are easing, interest rates go up. It tells you credit's being created, money's being created, and that's a good thing if you're in an expansion. You want to see interest rates go up. That validates higher equity prices. But when you see interest rates go down, a lot of people say, well, that's great because you can buy stocks on margin and for less interest. You can do all those things. But when interest rates are falling, it tells you financial conditions are tightening. And if you look at a long-term relationship between equity prices and treasury yields, what you find is when yields go down, stock prices follow with a lag. And it could be the same month, but upwards of 6 months. And the same thing is if you have rising equity prices, well, you better have rising treasury yields because they validate each other. So you don't get one without the other. And so when we look at the bond market today, we see it almost breaking through a topping pattern. 30-year treasury yields last night came down to 2.2. We look at this beautiful rounded top with a neckline, and it's telling you, hey, warning, 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 financial conditions are tightening, and investors are too busy clicking the bid on stocks to even notice it, but it's telling you something isn't right in the equity market, or it may not be right for a whole lot longer. So I think the bond market's important to learn about, even if it's not something that you trade. It should be something to look at.
What does he see as the likelihood of a stock market correction? Well, I'm using the word correction, but they use the word crash in the next 1 to 2 years. So what do you see? What do the charts say?
I'll say there's 100% chance of that. And that's a bold statement because you should never say anything's 100% of anything. But if you look at financial conditions, again, we come back to the bond market, it's telling you financial conditions are tightening. There's a lot of debt underneath the equity market. The global economy is starting to roll over. You see that coming out of Asia, not so much the US data, but that will lag because the US is a large importing nation. Our data is going to lag. So if you look out, say at China, you see that their manufacturing sector is peaking out, and you're starting to see that. So the issue is, will the equity market crash? The answer is absolutely yes, because if you look at quantitative easing, and that's something we're going to talk about, Noah, but if you look at quantitative easing, it's designed to tighten financial conditions. We're seeing that now in the bond market, which is interesting because back starting in August of last year, we saw the largest selling and speculative shorting event in the 34 and a half years or maybe 35 years of the treasury bond market. So everybody went massively short this thing, and it still didn't go up that much. I mean, 30-year got a little over 2.4, maybe 2.5. I mean, not much for the amount of effort here. Now we're seeing it tighten on the back of the Fed buying a massive amount of treasuries, 80.5 billion. Looking at 120.5 billion if you count all the mortgage-backed securities, which we should, and they're very relevant to the picture. You've got large commercial banks flooded with cash, forced to buy bonds to back all these deposits, and you've got foreign central banks also buying bonds, just as part of the cycle of what they need to do to keep the dollar cycling through the global economy. So, when you have all of these big powers still buying bonds, and everyone's short, well, you're going to get a massive short squeeze. You get financial conditions tightening, and then the wheels just literally fly off the equity market. So I am personally expecting the equity market to completely collapse in the next year. Yes, in 12 months. Yes, I don't think I'll have to wait 2 years to see that.
So if you don't see QE as inflationary, do you see the stimulus checks as inflationary?
Yeah, absolutely, but only on a temporary basis. as long as I mean, it's hard to argue that you give people money and they go out and spend it. We just had this confluence of everything was shut down and we gave people money. I mean, we can go back to prior stimuluses if we can find out that in a normal function economy, they don't really do much. I mean, a little bit. And that's because about a third of the stimulus is spent, a third is saved, and a third goes to debt payoff. So if you break down this pie and you say, okay, a third goes to spending, there's your inflation, right? And then you look at a third goes to debt payoff. Well, that's just destroying money. And then a third goes into saving, which doesn't do anything. I mean, well, arguably it forces the banks to buy more bonds. So you look at the stimulus and you see that, okay, this thing, it can't do much. Now, if you have persistent stimulus and an economy that's persistently shut down, so we're artificially driving the price of goods and services up, yeah, you can get it. But the moment everyone goes back to work and the stimulus goes away, then you should see the inflation go away. And I suspect if we don't see that this week, or start to see it this week, and we are seeing some of it in terms of the CPI data out of the other parts of the world, we're starting to see disinflation. We may not see that here in the U.S., but if you look at the year-over-year rate of change in crude oil, which energy is a very volatile part of the CPI, it suggests that the CPI print this week could be disinflationary on the month over month. And if not, then I suspect the following month, especially due to the base effect all coming up from their pandemic lows, we'll start to see this, inflation roll over, become transitory. But coming back to the original question, can stimulus be inflationary? It can. You've just got to keep doing it, and we're done. And we're almost done. I think there's still some checks to go out, but overall, it's pretty much done.
Okay. So you see the stimulus as inflationary, but on a short-term basis. That's what I'm getting from that answer.
Correct. Very transitory.
So what about the inflation that we're getting at the moment and that we're seeing at the moment? Do you see that as transitory?
Well, absolutely, because the economy is shut down. So you give someone, still parts of it are shut down, where you give someone money, they want to go buy something. There's not very many of them being built because we either can't get them in the country, can't get them from the ports to the store's not fully open, or there's a part missing. And people are like, well, I got an extra $1,000, whatever their check was, and they don't care because it's not their money. So it's like, oh, well, it's an extra couple $100, fine, boom, I got the money, I'll pay for it. So yeah, you see all this inflation is going to be transitory, especially since without the stimulus checks, incomes are going to go below where they were. So you think about that is, well, if my income is going lower than before and I don't have a job, or maybe I do have, or maybe I get a job and that job pays less. And if I don't have a job, well, unemployment's going to be a whole lot less. How can I drive inflation if my spending is going to go down? That's the real key. Everyone's, it's just weird to me, Noah, that for 40 years, we've been in a disinflationary environment. The Fed has done many things to create inflation. And the federal government has done stimulus and has done deficit spending. And all of a sudden, you shut the global economy down. You give people some checks. And now people think we're in a secular bout of inflation. And the reality is that's not going to happen. I mean, you can go back before the pandemic and you can see we were at full employment to the government statistic. And what did you see? Disinflation. So the notion that somehow all of this is going to turn into some massive secular demand for goods and services, I'll argue the fact that the stimulus checks created that demand, and without them, you're going to have an extended period where people aren't going to, not only not going to need things, they're not going to have the money to do it anyways. So yeah. I expect all of this to be very transitory.
Okay, so I can see what people are seeing now that I've heard your answer. So I think it's where you're saying you can't see any connection, but there is a connection. It's just not the exact connection that people think you're saying. So what you're saying is it's not as a result of the QE, it's a result of the low interest rates and then people then going out and doing it. So there is a connection, it's just not a direct connection is what you're saying.
Well, yeah, and so what happens this is where it gets interesting to me, is because people can't fathom the stock prices can go down. But if you look at what QE does, is it tightens financial conditions until it spurs enough credit growth to ease them. So the Fed's continuing to tighten things. So if you're tightening things, there's less money. And at some point, there's less money to support high stock prices, high real estate prices. Yeah. If there's not enough money to support them, then all of a sudden you get the bearish arrow comes out and the down stock arrow comes out. And that is what will challenge people, because the answer should be is, we should be able to just shut off the stock market, right? Just say, look, nobody can trade today, and the Fed's just going to do QE. And at the end of the day, stock prices should magically go up. And I guarantee you that won't happen, because it's a market. You need buyers and sellers. The problem is right now is people think, they think, okay, QE makes asset prices go up, so I'll just borrow money and buy stocks. Well, which one really made them go up? Which one's really making home prices go up? Is it all these people that run around buying homes? Or is it the Fed? I will say it's all the people buying homes and all the people buying stocks.
Okay. I'm glad we clarified that, because that was actually, just so you know, that was one of the things that a lot of people in my community were saying. They were saying, Steve's saying there's no connection, but there must be. And now I think that clarifies the point there. So I think that's important. The next thing then is, in terms of QE, I don't know if you've heard my theory on tapering it off over the next 2-3 years, but I'd love to know what your theory is on the tapering off. How do you see that occurring? Do you see it similar to the 2008 crisis we went through? Do you see it differently this time, and why?
Yeah, okay. So this is cool, because I want to marry the last conversation into this. And now we're coming back to, why is the bond market so important? Because what is it telling you? It's telling you yields are looking like they're headed down. It's telling you financial conditions are going to tighten. And I'll challenge all of your listeners and viewers to look at the long-term relationship between yields and stocks. Yields go down, stock prices soon to follow. So now the question then becomes is, what's the Fed going to do? More QE, which is brilliant, because now you start getting into my macro thesis, and people are like, well, how can you even like bonds? Because the Fed's, not only does the Fed buy a lot of them, they're going to buy a whole lot more. And I'll tell you why. Because when financial conditions tighten, as interest rates go down, which we know is going to happen, the Fed has two choices. What are they going to do? Are they going to raise the federal funds rate and do quantitative tightening? Probably not. Or are they going to, well, they can't lower the federal funds rate, it's effectively at zero, or are they going to do more quantitative easing? Well, they've convinced the world that QE eases, and the world is convinced that QE eases. So they're going to do more, which is going to hyper tighten financial conditions, cause a crash, drive interest rates to zero, or they're very, very close. Across the curve, you're going to see short-term rates go negative, and probably intermediate term go negative, and maybe long-term rates will get to zero. And if they go as in negative, we have deep problems. But the Fed's going to do more QE because everyone believes it works. They believe it works. And all it's going to do is crash things. And then the Fed's going to turn around and say, not our fault. It's the pandemic and everybody else not doing all these things that we thought they should do. They got a free pass out of this, but it doesn't matter. That's how the end game plays out. Financial conditions tighten, Fed does more QE, and all it does is tighten financial conditions even more. But the great part is it will lower interest rates enough to hopefully spur credit growth. And that's what we saw in the financial crisis. They drove rates down enough through QE to spur credit growth. The only question now is, how low do they have to go?